Welcome back to Front Row with Coronation. We look forward to sharing our views on investment matters that we hope are of value to you. As always, we welcome your feedback and invite you to send through topics and questions that would be of interest to you in upcoming editions. The winning entry will receive 10,000 Rand to invest in one of our unit trusts. So stay tuned for the announcement of last episode's winner. In today's episode, Naledi Makiwane will take you through why it is so important to stay the course, drawing on what the COVID market meltdown reminded us about what investors should and shouldn't be doing in times of crisis. Then we take you through Coronation's digital investment platform, where you can manage and monitor all of your investments securely online and in one place. But first, I chat to Senior Portfolio Manager Neville Chester as he builds the case for South African equities. He will share what sectors of the market are attractive and what the outlook for this asset class is over the next few years. Welcome to Front Row, Neville. Thank you for joining us on the show.
Pleasure to be here.
Today we're talking about equities, more specifically the South African equity market. Now, we know that equity is a fundamental building block in any investment portfolio, but investor appetite is low at the moment. In fact, if you look at industry flows over the last few years, investors have actually been pulling money out of the equity market. What do you think has led to this level of disinvestment from investors?
Look, there's a lot of factors that have been weighing on the South African equity market. But if you look at the broadest ones, so starting right from outside, the reality is there's just been very little growth in the South African economy. So from a macro perspective, low growth market, very little interest, very difficult for businesses overall, all industry to grow in a very tough macro environment. Overlay that, there's been a number of changes that have happened recently which have just added further pressure onto the SA equity market. We've seen the relaxation of Regulation 28, allowing asset managers to take a significantly greater amount of their assets offshore. And we're seeing, regardless of valuations, we are seeing pension funds and managers take money offshore. From a foreign perspective, there's been very little interest, mainly that's related to the macro. They're focused on markets where there's less risk and potentially better growth returns. And then there's been selling locally as well, from things like Sasria needing to create liquidity. You've also got an environment where government bonds, given the real yields that they are offering at the moment, 11% nominal returns, 4-5% real returns, also make a compelling argument against the risks of equity. So in that environment, there's a whole load of factors that have gotten us to where we are at the moment.
What about issues like Eskom and the brutal load shedding that we've had to endure? Surely that has a material impact on investor appetite.
It does. I mean, it affects sentiment clearly. It affects overall economic growth. And then there's specific industries, that are more seriously affected than others. Having said that, given that we've had load shedding for 12, 13 years now, South Africans, as always, we found ways to get around and manage it. But undoubtedly, we would have significantly better growth prospects if we had a reliable power system. So undoubtedly it's challenging. But even in that environment, there are still businesses which are succeeding. And that's the idea, is to find those that are.
So, we've touched very briefly on some of the challenges facing South Africa, and I'm sure if we put pen to paper, there's a long list of things that weigh on the minds of investors. Despite that, though, if you look across the Coro portfolio range, we are currently in a position where we are overweight South African equity. And I think the average investor out there would ask us how we can justify an allocation to, such a high allocation to SA equity at a time where the macro picture looks so poor and so challenged. And how would you answer that?
Look, for us, it always comes down to valuation. Really, that is the bedrock of our investment process, how we put portfolios together. And, if we look at the value of stocks today listed on the JSE, and again, that's very important to bear in mind, is it's not just South African companies, but we know there's global businesses listed on the JSE, our mining companies listed on the JSE, which, small exposure to SA. But if we look at the JSE listed equities, we think it's one of those fantastic buying opportunities that we see only every 10 or 15 years. In fact, we have to go back to the global financial crisis before we can see as much upside as we see today in the local markets. Given what we spoke about, just the lack of appetite for local equity, these share prices are trading at very, very attractive levels for long-term investors. And if you look at the different kind of breakup, commodity shares, we think the market has taken a very, very negative view about the outlook for commodities from here on. We think it's not nearly as negative as that. And, already we're seeing sentiment shift globally. We're seeing people think maybe, we reached the peaking point of global inflation. Already there's a bit of a change in sentiment, and we can see just how quickly share prices move. And for that, it's important is you can't time these things. You don't ever get to see the catalysts before they arrive. It's about identifying the value, and we're long-term investors. It's not for us to try and identify the catalyst that's going to drive it. It's saying, is there value there? And if there is, we think it's one of the great kind of opportunities. And inflation, as we mentioned, has come back. It is higher, and we need to find ways to protect clients from that inflation. And SA Equities really is one of the key opportunities that we can see to do that.
So if I understand you correctly, what you're saying is that we actually can afford to have quite an optimistic view on SA equity without necessarily sharing that optimistic view on SA itself. And this is about price and valuation.
Absolutely, yeah. As I said, if you look at our SA portfolios, and we've mentioned this quite a few times, you can really break it into three buckets. There's global shares that just happen to be listed on the JSE. So your British American Tobacco, the Naspers process, those are shares that we think are actually just very cheap by global standards, with very good significant upside, and that performance comes, completely irrelevant what happens inside the SA economy. The commodity shares I spoke to, some of the specific commodities we think are not going to be coming back. And in fact, a lot of commodities have had a boost, obviously, with what's been happening in Europe with the Ukraine war. Certain commodity prices are going to stay higher for longer. And the cycle, this is a very different commodity cycle to previous ones. We're not seeing the cash going into top of the cycle M&A. In fact, we're seeing a lot of that cash come back to shareholders. And we think there's great opportunities still in the commodity sector. And then, there are some specific businesses, the point I alluded to earlier, which it's not about the whole pie growing, but there are certain companies, well-managed businesses that are actually able to take market share from some of the other competitors and still actually deliver real meaningful growth. And when you look at the ratings that a number of these are on, they're not getting any credit for that. So, also it's incredibly difficult to be an optimist in South Africa. We get bombarded by news flow. And that news flow then reflects in asset prices. So if you look at a lot of the asset prices, they reflect the most negative situation. And the one upside, if you will, from, I guess, the low base that we're on is it doesn't take much of a delta, not much of a change, to actually make a meaningful change for some of these businesses. If we had a reliable power supply, that would be a situation which we haven't had for over a decade. That can make a meaningful, difference to businesses' growth. If we had some of the investment that's been spoken about actually going into the ground, that will just raise GDP growth just to that much higher level. And then there's a lot of industries and businesses that would benefit from that.
I think it's quite an important point you make, because I think very often when investors think about SA equity, they focus very much on the tight economic conditions and ask themselves, how are businesses going to be able to grow in this kind of environment? And the point you made around the fact that we have exposure to these global multinationals, the commodity stocks that are not really reliant on SA, it's quite important. Tell me, on the domestic side, so you talked about the other two parts of the market that are attractive. What kind of opportunities do you find there, given the tougher landscape, and how these businesses are likely to fare over the next few years?
Look, an area that we think is particularly attractive right now is the banking sector. Been through quite a torrid time, obviously COVID and the lockdowns, people very concerned around the quality of the book. We've had lower interest rates. That's all changing now. So we're coming through that environment. Interest rates are starting to tick up, and we expect rates to keep moving up from here. Obviously, central banks are starting to take a view around inflation a little bit more seriously. But that's a net positive for the banks because of the endowment effect. So when interest rates dropped during COVID, their margins were impacted significantly because of their capital earned a lower return. With interest rates ticking up, Their margins are picking up, and we've already seen some of the banks report very strong results. Usually the offset, though, when rates go up is that people start to go into more financial stress, so your bad debts pick up. Coming out of COVID, though, the banks all have huge provisions. They put aside a lot of money during the COVID period, and actually it hasn't been used. Generally, corporate SA came through quite well. So the banks are coming into this rising rate environment fully provisioned. So we see them just getting the full benefit of wider margins and not actually losing that much on the bad debt side. And then on top of that, if you're looking at a way to potentially benefit from the kind of infrastructure spend that's starting to take place, the banks are uniquely positioned. They're going to be funding a lot of the renewable power that's potentially going to come on. And it's not relying on government, actually. We've seen a lot of private sector players, the mines, all say now with the lifting of the cap, they're going to be investing in their own power supply. So we see pretty decent advances growth coming as well. So you see good organic growth, you see wider margins, and they're paying out a huge amount of that capital as dividend. Nedbank, one of our big holdings, on a 7% dividend yield, that's significantly better than you can get from putting your money on deposit at Nedbank. So we think that's an area that stands to benefit with very good earnings growth for at least the next 2 years.
So from what you described, it sounds as if there's incredible breadth of opportunity across the SA equity market. And you talked about, the attractive real yields available in the government bond market. But how do SA equities stack up relative to the other available opportunities at the moment?
Yeah, look, we still think it's our favorite asset class. If you look at the multi-asset funds, you will see certainly those with the risk budget, a full weighting to domestic equity. We did take advantage of some of the sell-off offshore to start upweighting our global equity position. But really, we do feel a little bit spoiled for choice at the moment because, as you correctly point out, government bonds also look quite attractive at these areas. So we're really running with no cash, basically. I think in this environment, with inflation where it is, with the cash kind of return rates, that's just locking in real losses. And especially given the alternatives, SA equity, global equity, SA government bonds, kind of ranked in that order.
One of the funds you manage is the Coronation Top 20 Fund. And a reminder to our investors that this is a pure equity portfolio that gives you exposure to our best 20 ideas listed on the JSE. Now, given the views you shared with us today, can you give us an idea of what investors can expect from a fund like Top 20 over the next few years?
Look, as I said, we track the total upside to our analyst models compared to where they're trading on the JSE. And again, this is our long-term fair value, so it's not what we expect them to do in the next 12 months. But we see upside in the portfolio in excess of 50%, which, over 3 years is talking to, mid kind of double-digit 12 to 15% per annum return potential over the next few years. So we're very excited. I think, when I look at the portfolio, when I look how it's structured, it's got a nice balance. It's not overexposed to any particular sector, yet we still see significant return opportunities coming into the portfolio.
So it sounds to me like, we're quite optimistic about SA equities. It certainly makes the case for why investors should have exposure to this asset class, despite the negative headlines, the scary narratives that play out. And I'd like to thank you again for your time, and thanks for your valuable insights. I'm sure you've left investors with a lot to think about.
Absolute pleasure. Thanks, Amika.
Next up is Naledi, who will take you through why it's so important to trust your fund manager's process, even if they underperform in the short term. She'll highlight why you stand to benefit more by staying invested rather than jumping ship at a point of maximum anxiety. She'll also address the winning question from episode 3.
Market drawdowns, when markets sell off sharply as they have done this year, can be daunting. The uncertain environment, combined with declining stock prices and high levels of volatility, understandably provokes anxiety in investors. The temptation during these times is to take your money out of the market and get back in when things have improved. However, this is the classic way that investors end up eroding their investment returns. That is why we encourage you to trust the process and let your fund manager focus on delivering long-term performance. To illustrate why we advocate this approach, we look at the market downturn brought on by the COVID crisis in February and March 2020 and then the subsequent recovery. Coronation is a long-term valuation-driven manager. What that means is that we invest in assets based on what they're really worth and not on short-term investor sentiment. Instead of responding to the financial market ups and downs, we look to the long term to deliver on your investor needs instead. The price of this philosophy is that we sometimes underperform in the short term, and you may temporarily experience negative or low returns. But you'll see from our performance during the COVID downturn and afterwards that sticking with our investment strategy was the best way to ensure that you participate in the long-term outperformance of our funds. Let me take you through what happened during and after the stock market declined suddenly when the COVID pandemic struck. The graph on the screen compares the performance of the Coronation Balanced Plus Fund to the 3 funds in the same fund category that experienced the smallest declines in performance when the market reacted to the news of the lockdown in Italy in February 2020. As you can see in the graph, these 3 funds didn't fall as far as the Balanced Plus Fund did at the time, with the difference between the average return of these 3 funds and the Balanced Plus Fund being 15.1%. However, by the end of the 2020 calendar year, a mere 9 months later, the Balanced Plus Fund had already won back this difference. And by the end of the following calendar year, Balanced Plus had outperformed the average of those 3 funds by 10.5%. This shows that remaining invested in our Balanced Plus Fund would have been the better long-term strategy. The winning question from episode 3 of Front Row was, why do some investment philosophies do well in certain economic and financial markets, while others perform better at other times? This is the case because managers have different research processes that result in different investment decisions. Even managers with similar philosophies can have widely divergent short-term performance. This is why we recommend split funding, where you choose managers you trust and whose philosophy you understand, and then split your money between these managers. This inevitably leads to less volatile overall performance because you mitigate the impact of an underperforming manager on your portfolio. Split funding therefore makes it much easier to stay the course. Going back to our example, let's look at a scenario where you split your money equally between the 3 biggest funds in the high equity multi-asset category in February 2020. As you can see, that portfolio would have underperformed compared to the 3 funds with the best drawdowns during the sell-off. However, just as we saw with the Coronation Balanced Plus Fund, the average performance of the 3 biggest funds rebounded and, by the end of the 2021 calendar year, had outperformed the 3 best performers in the March downturn by 7.5%. This again confirms that by sticking with your investment strategy, you will experience better return outcomes over the long term. Had you switched at the worst point out of the split fund portfolio of the 3 biggest funds into the 3 funds that performed best during the downturn, you would have been 17.1% behind as at end December 2021. Another reason to trust your fund manager's investment process is that it's when you feel the most worried that we as asset managers find great investment opportunities that allow us to buy assets at very attractive prices. The way we determine whether assets are priced attractively is to use a measure we call upside to fair value. When we analyze a stock, we calculate its fair value, which is what we think it's really worth, and then compare this to the price the stock is currently trading at. If the share price is lower than its fair value, then the difference represents the upside to fair value. Typically, when a stock has performed well, there is less upside, and when it has performed poorly, there is more upside. So this is the part where we get very excited. The graph on the screen shows the correlation between the upside we have seen in the past, represented by the blue shaded area, and the subsequent 2- and 3-year returns for the equity carve-out of the Coronation Global Managed Fund. It shows that the higher the upside to fair value, the higher the returns over the subsequent 2- and 3-year time periods. The upside in the equity portion of the fund is currently between 80% and 90%, a level not often seen in the past. But when it has been this high, the following 2-year returns have averaged a phenomenal 21% per annum. In addition, this relationship also applies to local equities. If we do the same exercise for the Coronation Top 20 Fund, which invests in local stocks listed on the JSE, you get the same results. We completely understand how nerve-wracking it is to watch the value of your investments decline during difficult periods in financial markets. But the evidence shows that if you trust your investment manager's process and stay invested, you will reap the long-term rewards.
Thanks, Naledi, for taking us through your thinking on why it's so important to stay the course. For me, there are 3 key takeaways. Selling out of a fund based on short-term underperformance is often costly in the medium to long term. Market crises provide attractive investment opportunities to buy assets at far less than they are worth. Finally, trust your investment manager's process by staying the course because you are likely to come out ahead. Next up, we share a video that takes you through our online services. It will show you how easy it is to manage and monitor your investments on our digital investment platform, allowing you to do a lot more than you think. Thank you so much for joining us on Front Row with Coronation. We hope you enjoyed the episode and look forward to hearing your feedback. Please feel free to submit your thoughts in the feedback section below. Don't forget that if you suggest an idea or pose a question that we can include in our next episode, we'll top up your account with 10,000 Rand. We look forward to seeing you again in the front row.